In this presentation, we will continue on with part 2 of our example problem related to a private college. The second private college example problem we have taken a look at. We will be recording transactions, going through transactions, continuing on with transactions. First transaction, we will be recording the expenses for the time period. We will be grouping the transactions for the expenses together. In other words, obviously the expenses would typically be recorded throughout the time period with multiple transactions. We're going to record them in one lump transactions to record the expenses for the time period in an efficient way and in a fairly quick way. This will be similar to a for-profit type of organization. If you would like more detail on breaking out the expenses, recording the expenses, you can take a look at some of the financial transactions in a for-profit organization, which we do have a course on. So we're going to record the expenses of instruction expense for the time period, academic support, student services, institutional support, and auxiliary enterprises. And those are going to be the things that are kind of outside, you'll recall, the normal type of business activities for the organization, which would be related to the school, possibly some type of sales outside of merchandise or something like that, outside of the normal type of primary income of tuition and contributions. All right, so we're going to be debiting those items then. We're going to be picking these up in the expense categories: the instruction expense, the academic support expense, student services expense, institutional support expense, and auxiliary enterprise expense. Then the credit will, of course, be to cash, the sum of all of those items. So we're going to record these expenses for the entire time period, posting them then to cash. Posting this out, it would look like this. We're going to have the instruction expense. That's going to be increasing the instruction expense in the debit direction. So the expense goes up, bringing what would be net income type number down. We're going to do the same thing for the academic support. Academic support going up in the debit direction. We have the student service expense going up in the debit direction. We have the institutional support expense going up in the debit direction. We have the auxiliary expenses going up in the debit direction. The credit then going to cash. Cash up top has a debit balance. We will then be crediting it, making the cash go down. The effect on the net income will, of course, be a decrease. So the credits minus the debits have now increased, making the net income type number go down. Here's what it was before. Here's the change. Here's what it is after this transaction. Next item, we have the instruction provided and services related to the grant we paid in cash. So we had instruction expense, instruction provided. We're going to record that transaction. That'll be fairly straightforward. Then what we're saying is there's something happened that we're going to free up the grant money. We got grant money specifically for some type of instruction, which this satisfies. Therefore, we need to free up the grant money that we have been receiving. So the first half of the transaction, the more straightforward half, would then be an instruction expense debit for the $530,000, and we credit the cash that we have spent on it. Posting this out then, we're going to say that the instruction expense is going to be here. It's going to go up in the debit direction, and then the credit is going to go to cash. Cash is going to be up top. We credited cash, making cash go down. And that, of course, will keep us back in balance. The effect on what would be similar to net income is going to be a decrease in that number. Then we're going to have the second component, that what we spent this money on is what some of our money was restricted in order to spend it on. Anytime we spend money on something that qualifies for some type of restriction that someone has put on us with some type of funding, we assume that money that was given to us was the money that we spent. In other words, we're going to free up the restricted money, and we want to make sure that we do that whenever possible with another transaction looking like this, taking a look at these two accounts. They can be better seen over here. Net assets released, satisfaction of purpose restriction with donor restrictions. Net assets released, satisfactions of purpose restriction without donor restrictions. Now, what we're going to do is the one without donor restrictions, this one's always going to go up. You want to consider it going up in the credit direction, kind of like a revenue account going up, increasing in a credit direction. The one with donor restrictions, you can think of it as going down, or you can think of it as like an expense increasing, however, decreasing basically the net income type of number. So these two accounts look very similar. The difference you'll recall is with restrictions or without restrictions. The one without restrictions is an increase, and we increase with a credit basically on the income statement type numbers because it would be like revenue. Posting this out then, we're going to say that the debit is going to go to the one with restrictions, which is going to basically increase that in a credit direction you could think of, or decrease net income. That's going to make net income go down. The one without restrictions then is going to be increasing in the credit direction. That credit is what's going to be bringing income up. So the credit is good, you'll recall, increasing the credit. And this is always going to be the case. The one without restrictions will always be going up, and the one with restrictions is going down. These two accounts are always to unrestrict. They're always going one way. These two accounts are not used to restrict. Therefore, they won't be going the other way. Okay, now we're going to have the transactions that will be related to kind of like the adjusting entries at the end of the time period. We have the allowance for uncollectible tuition and fees has increased. So if you consider up top, we have the tuition and fees receivable. Then we have the allowance for doubtful accounts below it. This is similar to a for-profit type of organization. Anytime we have a receivable, we should be considering how much of that receivable would be uncollectible and then recording that estimate for it. The estimate here says that we're going to increase that by the $8,800. So we're going to credit the allowance for accounts by the $8,800, decreasing the amount of the net receivable. The other side then, the debit, is going to go to tuition and fees without donor restrictions. And that makes sense because we're in essence just simply reversing the credit here. The revenue we posted in this time period is going up during the time period. It's going down now, but it generally goes up during the time period when we recorded the receivable. Now we're going to take it back down when we consider that some of those receivables, part of those receivables, will not be collectible. This is a little bit different than a for-profit type of organization where we don't typically reduce the sales number, the revenue type number, but instead make another account called bad debt expense. So that's going to be a little bit different. Concept is the same. We're going to be saying that the tuition and fees without donor restrictions is decreasing the revenue account. Again, a little unusual, but it makes sense to do that. And then the other side is going to be the allowance for doubtful accounts up top. Has a credit balance. It's going up in the credit direction. That, of course, brings down the kind of net value of the receivable, the tuition of receivables, which is going to be obviously the tuition of receivables minus the allowance. Next item, we're going to have the fair value of investments has increased. So the fair value of the investments increased. So we've got the investments on the books here. You can think of them as like stocks possibly, which have increased in value. We know that because they're on a public exchange. So then we're going to record that increase in value to the investments. We're going to increase the investments to agree to the fair value. The credit then has got to go to some type of credit somewhere, which is typically revenue. So we're going to call that unearned revenue or unearned gain because we haven't yet sold it and therefore haven't earned it. And then there's going to be some restrictions on it. We have here amount associated with endowment and allocated to net assets with donor restrictions is the $5,440. So the amount of the investments that are related to an endowment and therefore restricted, and that typically happens when we have an endowment. The permanent amount of the endowment is something we cannot spend typically at all. The income on it, the investment income, the gain, and any type of investment income, typically we can spend, but has some type of restriction on. Therefore, we're going to say part of that $13,140 that we got is going to go increasing the gain on the unearned gain. However, it will be restricted with regards to an endowment. So we're going to put that into a revenue account with a restriction. Then the rest that is not restricted, we're going to put into the unearned gain without donor restrictions. That's going to be the other component of the credit. Posting this out then will look like this. We're going to say that the investments will increase. Here's the investments increasing in the debit direction. Then we have the two credits to the unearned gain. One to the unearned gain without restrictions, one with the unearned gains with restrictions. That'll then put us back in balance. And of course, the effect on what would be similar to net income would be an increase now. The credit, in essence, going up for these unearned gained amounts. Next, and finally, we have the depreciation. So we're going to record the depreciation, a common adjusting entry in a for-profit type of organization. If you want more information on how to calculate depreciation, we do have courses on that. It's a long topic in and of itself. But the idea of the depreciation is, of course, we have the property, plant, and equipment. In this case, equipment for us on the books. We didn't expense it when we purchased it. We put it on the books as an asset. And then we are going to allocate the expenses over the useful life of it in accordance with the matching principle or expense recognition principle of the accrual principles. So we're going to do that by creating not equipment expense as we allocate the expense, but something called depreciation expense typically. However, here we're going to allocate not to depreciation expense, but allocate it to where we think the depreciation was used for functionally, which will be instruction, auxiliary enterprises, and academic support broken out in this fashion. So therefore, we're not going to have a debit to expense. We're going to be breaking it out by function, what we used it for, rather than by nature, depreciation expense. The credit then is going to go to accumulated depreciation, just as we would expect normally in a for-profit type of organization. So we're going to increase the accumulated depreciation. It's a contra asset account. So therefore, when it goes up, it'll decrease the book value. So recording this out would look like this. We're going to say that the instruction expense, auxiliary expense, and accumulated depreciation are going to go up with the proportion of the depreciation expense we are allocating to them. So here are those increases with the instruction expense, the academic support, and the auxiliary expenses, increasing those amounts. The credit then going to accumulated depreciation. Here's accumulated depreciation, has a credit balance in it. It's going up in the credit direction to this credit balance. That increase, of course, will be decreasing the book value. So the book value being the difference between the cost and accumulated depreciation.